everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. So I have a fantastic guest with me today, and one that I have been looking forward to having on for some time. And this episode really could not have come at a better time. Investors are faced with a lot of concerns and worries right now, which makes building an investment portfolio very difficult. Market risks and uncertainties continue to grow. We have concerns regarding the health of the banking sector, uncertainty about how high the Fed will go with rates, or will they cut rates this year. We have increasing geopolitical risk in a slowing economy, just to name a few. So with that backdrop, I think you will really enjoy today's guest and learn a lot, as I know I will, as I'm sure it's going to be a very engaging and entertaining conversation. But first, today's episode is sponsored by the award-winning Zephyr, which helps advisors, wealth managers, financial analysts, and investment professionals make more informed investment decisions. So enough from me. Let's move on to the star of the show. So I'm very excited to introduce Rob Swan of Swan Global. Rob is the portfolio manager and chief operating officer at Swan. So welcome, Rob, and thank you again so much for coming on the show. So let's start with a little bit more about yourself.
Sure, thanks. And thanks for calling me a star. I'll have to get you to talk to my wife and maybe pass that on to her. So a little bit of background about myself. My background happens to be aerodynamics engineering. I spent a lot of time up in Seattle while I was up there as an engineer. My brother, Randy Swan, who is the founder of our firm, was really looking for a better way to invest money. And it was really for our money, our family's money, his money. And it really was born out of a frustration with traditional asset allocation and its inability to handle bear markets. Most people know that when everything falls apart, all of the diversification and correlations that you like to see, low correlations between your different holdings, really increases and everything is falling in lockstep. And the damage that's done during those times to portfolios because of those bear markets can sometimes set you back for years. And for example, 2008-9, it took 4.5 years for the market to get back to square one. So he was really looking for a better way to buy and hold to get the long-term returns of the stock market, to minimize the impact of bear markets, and to avoid having to do any kind of timing or prediction of what the market is. Most managers have a hard time beating the market over the long run, and especially if you throw in emotions, then it gets a lot worse. And most people are massively underperforming just to buy and hold, let's say, of the S&P 500. So he, at the time, was working with offshore insurance companies, and that he was working on the tax side. But he saw that they managed portfolios a little bit differently. They were figuring out when your kid's going to get in a car wreck and how old you're going to be when you die, and they're pricing their policies consistent with a more mathematical risk and reward. And he said, if I could do this in the portfolio by hedging out the risks that I don't want and taking on the risks that I do want in an active way, then I would have a winning combination. So he launched the strategy back in 1997, and he found that options were the way to do that. Now, back at that time, there were very few people that were, other than institutions, that were using options. Now we see a much bigger adoption, widespread use of options, and a lot of really great products out there and strategies. But at the time, there was very few people using options. But options give you a much better way, kind of like an insurance policy, that allows you to set your price, your coverage level, like if you were buying insurance on your house, and you can fine tune it with a deductible. So you can move that, not only the amount of coverage that you have, but when the coverage kicks in. And so this capability with options, when used right, when used for hedging, not for leverage or speculation, became a very powerful way for him to roll out a strategy, and which has done phenomenally well for 25 years through the 2000 to 2002, 2008 and 9 scenario, really protected and demonstrated how the strategy worked. And it was at that time that he had been kind of bugging me to join him and help him grow the firm, really start to offer the strategy to other investors other than just friends and family, and to roll it out primarily to investment advisors to be able to use on behalf of their clients, and to give them a better tool in their toolbox to be able to navigate uncertainty in the markets. And as you said, now is finally, after this great bull market run, everybody has earned really good money. Our clients have benefited from that bull market run, but nothing goes on forever. We haven't solved the bear market problem, and here we are, maybe in more dangerous territory than even back in the 2008-9 scenario. We will see.
Exactly. It's interesting you brought up options. Options have always been a strategy people can use, but it seems like it really became mainstream during the pandemic. You heard all these retail investors, whether it was on Robinhood or what, they had all this free money, and the volume of options just went through the roof. And now it's so retail. And you had said it perfectly, how you use options the right way, right? Not so much as speculation, and that's where you can really get yourself into trouble. And especially when that option, goes the wrong way. So it's interesting you say that, especially with, the pandemic so recently. So fantastic. I always love the stories, the connections of how businesses are started, especially when it involves family. So I mentioned at the top of the show how it's a difficult time to create a diversified portfolio. And you mentioned it too, Rob, when, chaos hits, everyone runs for the exits and correlations increase. With that growing wall of worry also. Swan Global, as you mentioned, is an industry leader in equity hedge strategies, which is very important strategy during times like this. So with that, can you tell us a little bit more about Swan's investment philosophy of always invested, always hedged, and what that means?
Right. So if you remember, I was talking about the original goal was really to get the long-term returns of the stock market, but without any kind of timing. I mean, the problem is you have to be right multiple times. So it's great if you've got your magic 8 ball and it's telling you exactly what's going to happen in the market, then give me a call, because I would love to incorporate that reliable prediction of the future. And we can make a lot of money together, but it's really difficult to predict the market. And so what ends up happening, the reason that most investors underperform just buying and holding, is because they sell when they're scared, they sell out of fear, and the saying goes, buying out of greed. And so the timing is really important. If you're sitting on the sidelines right now, maybe you're sitting in cash right now, do you invest right now? Is this a great time to invest? Have we seen the lows, or are we going back off to the races? And so sitting there in cash with inflation raging is not a good answer. So you don't want to miss out on the upside, but you always want to be protected. So our view is that if you have the right protection in place, and we do that through hedging, always hedged, so we're always invested so we don't miss out on the upside, but we're always hedged, kind of like you would with your house. I'm not really worried about my house burning down. I hope nobody has had their house burned down, or in Florida where I live, you got hurricanes coming through, but I wouldn't think about getting rid of my insurance and trying to time the insurance on my house and waiting until I see a hurricane coming and then basically quickly trying to find insurance. That is not a cost-effective way. Further, even if your house has never been burnt down, you've probably paid your insurance premiums for years on your house, and you wouldn't think of getting rid of it. But that's what people do in the portfolio. So what we believe in is, we know the markets are going to sell off. They're going to sell off on a more regular basis than what we've seen over the 14 years prior to the pandemic, although the market was up, of all things, in the midst of 2020. But last year the market was down. But it's been a long time coming. So we believe that those are more regularly occurring events, and your insurance, unlike maybe your house insurance, is a sure thing. It's a sure payoff at some point, and probably multiple times that you are invested, you're going to see bear markets. And our goal with being always hedged, always invested, is we're not going to miss out on the upside, some of the upside. We're not trying to beat the market, when the market's up 30%, there's going to be some cost to the hedging, but we believe that having a smoother ride and having that hedge in place really takes a lot of the emotion out and really allows you to go and just kind of fire it and forget it, really. And one of our clients pointed out, sleep well at night. That's happens to be Swan. My compliance officer doesn't like it when I write that, but I think I could say it. So
yeah, that's one of the main, when I was in the industry, working with financial advisors, it was always, what can we do to make our clients sleep well at night, right? That's kind of the key, so they don't have as many worries. And you're talking about your house burning down, that kind of hits home a little bit. Up here in Lake Tahoe, it seems like every summer we're always concerned about fires, and we had the Caldor fire and the whole town was evacuated. And you always hear these stories about people not having insurance on their homes. And that's a great example of why, hedging is important in an investment portfolio. My next question was about the importance, but I think you really covered it. Really, why is hedging important? And should be a common strategy when creating a portfolio. I think you covered it. I'm not sure if you have anything more to say there in terms of the importance.
I would just using the insurance analogy, and again, what we're doing is not insurance, but options behave when used properly. They behave like insurance. You got farmers that hedge their crop risk, and you got airlines. Southwest Airline, basically, they became large and successful because of hedging their fuel costs, with futures. So that concept, it fits right in there, and you do that with everything else in your life. Your life insurance, your health insurance, your house insurance, your car insurance, why not basically take the same approach in your portfolio, which is going to be your biggest asset. You need to protect those assets. And we think that it just makes sense. It's going to happen. And you don't want to have to start over. If you're close to retirement or already retired and having to take out money after losing 30 or 40% of your portfolio, that is not a good proposition.
Fantastic. I think just with that, you probably have a lot of people sold on exactly why hedging is so important. But then the next question is, okay, I want to incorporate hedging into my investment portfolio. And maybe that most important question that comes up, or one of the most often, is how. So how do you incorporate hedging into a portfolio? Should I just go and buy a bear call spread option or a bear butterfly spread? Do you use a satellite approach or a core manager, a core holding? And, how much? I think that's really an important question.
Right. So, all great things. So I love analogies. So I would say if I basically had, a brain tumor, I would not basically be trying to read and figure out how to operate on myself. So I think that the good news is that there are a lot of managers out there. There's a lot of strategies that have even recently come on the market. They give people more of an option to find the right strategy or combination of strategies that can serve that purpose. I think, people say, well, when should I start hedging? And everybody gets this view. They try to incorporate their time. It's like, well, I should hedge right before the bear market occurs. Well, again, we don't know when that's going to occur. I have no clue. Everybody's up in arms about what's going to happen. Are we off to the races here? Or are we seeing, some serious downturns? And people are split. And I think that these things come out of the blue. We don't have usually a long runway. In hindsight, you usually say, well, I should have paid attention to that. So I think that everybody ought to have hedged equity as a core asset class, which is different than what most people think of. Because if you are looking to add technology to your portfolio, you might go and find a couple different managers or companies that have a different technology offering or a different particular sector or aspect of that market, and you're going to diversify across these different managers. But you might think of, well, how much am I going to allocate to technology? How much am I going to allocate to U.S. large cap or small cap or emerging market? That approach, I think, is more appropriate for hedged equity, because hedged equity is something maybe for irreplaceable capital, something that basically will give you more freedom to actually maybe take a little bit more risk in some of those other holdings and not have to time and go to cash and pay taxes if you have a core allocation that is dedicated, that you know is going to be able to weather that storm, and you can just put it in place and leave it alone, for long-term returns. So whenever somebody says, well, when's the best time to invest in hedged equity? I always say before you lose your money, just as a kind of joke, instead of after. It's now, even after, though, you don't know whether that's the bottom, you don't know where the top is, you're sitting in cash, you miss out on the upside, so you can take the cash off the sidelines, get invested in hedged equity, and you're going to have much more safer access to the equity fuel that is really kind of the only game in town right now, and has always been a great game, or a great place to basically have long-term returns. And so size-wise, I think it can fit into any portfolio. I think you could even say, a 20% allocation, 30%. I think that hedged equity can handle those type of allocations, because it is an asset class. Switch between different managers if that's what you want to do, but get some hedged equity in the portfolio, and it will allow you to make better decisions in other areas, and basically allow you to sleep better at night, like you just talked about.
Perfect. That's fantastic. I know I just read some research yesterday saying some big Wall Street analysts were saying they want to be fully invested now, because once the Fed cuts rates or stops their rate cuts, the market's going to take off. But again, when is the Fed going to cut rates, right? There's so much uncertainty. They haven't exactly been spot on over the past couple of years. So it's one of those things, you don't want to time the market. It's a loser's game, right? Fighting the Fed, you don't want to fight the Fed. It's you're better off just being prepared and have a plan in place, right? You brought up a great point, and you've used insurance as an example throughout this conversation. And obviously there's a cost with insurance. I would think as volatility increases, if all of a sudden you buy insurance right before a fire hits or right before a hurricane hits, cost is going to be pretty high, right? If you can even get insurance. So this might be a reason to, always be hedged. Does it get more expensive as markets become more volatile? What is the cost to hedging?
I think that a lot of people think that there is an excessive cost to hedging, and I would basically approach it in several different ways. Hedging your house is expensive. If you want to basically buy hurricane insurance, once a hurricane is barreling down on New Orleans, good luck, or maybe even the wake of that type of hurricane. So I think it's important to basically make sure that you've got the hedging in place, before things start to look bad. And then once you've got a hedge, whatever cost is going to be associated with being in a more volatile environment and having to maybe roll to the next hedge is going to be transferred from the profits that you get in the existing hedge that you have. It's kind of like being a real estate market. Even if prices go up, if you're already invested and you've got a house, you could sell your house and it's going to be for more money, and you're going to pay more money for some other house. And so I think that the concept of always being invested, always hedging, instead of tactically trying to time your hedge and put on some supplemental thing because you think it happens to be more more volatile or more dangerous right now, is the better way to go. So but I would also say, because bear markets generally occur much more often than your house burning down. My house has never burned down, but I've carried insurance and it's a sunk cost, and I pay my premiums, and I probably will never get paid back. But unlike that, the markets are going to sell off all the time. So if you follow that disciplined approach, you are going to get paid off over and over and over again. I think people would be surprised at how much money, profits that the hedge will generate when the markets sell off. And then you basically go through a period where the markets rally for a period of time. Your underlying equity is doing great. You're insuring your house. That's the most important thing. That's the lion's share. It's your house. It's that value that you're kind of ratcheting up, but then preventing it from losing a bunch of money or burning to the ground. And if you basically get a new house every 5 years when the markets on average sell off, then you're going to be way ahead of the game. And I think that the costs are much lower than what most people think they are when applied to the markets and when you're buying the proper type of hedging.
Perfect. I'm knocking on wood right now, so nobody's house is burned down, or hurricanes hit over the next couple of years. Rob, that was fantastic. It was a great conversation. I learned a lot on hedging. That, you know, it's always one of those topics that you know you should do, just like insurance. You know you should have insurance, but it's just fantastic learning so much more about it from somebody, an industry expert. So one of the things I like to finish the conversations off with stories. You mentioned you were in Seattle, you had some good stories, family stories, any interesting thing you've seen recently that you'd like to share?
So stories related to the market or just any story at all?
Anything, Rob, that
Okay.
is family appropriate.
Okay. I'd probably say that one of I guess my best stories or experiences when I lived up in Seattle. I moved up to Seattle to work at Boeing, and I was there for probably 10 or 11 years, and then got involved in a software company before joining Swan and my brother to grow the business. But back before I had kids, living up in Seattle, my wife and I had opportunity to take some sailing lessons, and we fell in love with sailing so much that we sold our house and moved on a sailboat. And anybody who's familiar with Seattle, we lived up near Shill Shoal Bay Marina, which is right next to where the locks, where they do the deadliest catch, where all those boats are kind of centered out of. So we moved on a sailboat. This was before we had kids, and which was, I mean, our parents thought we were crazy, you know, why would you give up on a house? But it was great. You could pick up and move. You go on vacation, everything's already packed. You know, you don't have to mow your yard. You know, it's such a small place to live in a boat. You can't go buy furniture because you have nowhere to put it. So it was really a great time. And then we, you know, after doing that for about 4 years, we basically decided that we wanted to take a big long sailing trip, and so we sailed the boat out of Seattle down to California. We went basically down into Mexico, up and down Mexico, and then we went across to the Marquesan Islands and Tahiti and Bora Bora, and up through Hawaii and back to Seattle. So we took 11 months on that sailing trip. So, and it was just the two of us, you know. So we had lots. There was times when you're cursing airplanes that are going overhead and are going to be there in 3 hours. But it was a phenomenal trip. Had a great time, and had memories that, you know, you just can't replace those memories. So anybody who loves sailing, that I would highly recommend that, you know. And you know, still into boating. That's why I'm living in Florida now, because I love the ocean, you know, after spending that year out on the water.
That is awesome. My first thought is, you know, before we went live here, we talked, you know, I lived in Seattle for some time too, and I had some friends that lived on houseboats, and I always thought they were very cool, you know, to live on a houseboat. And sailboat's a little bit different. My second thought is, gosh, I don't know if I know anybody that would be willing to live on a sailboat and be stuck at sea with me for 11 months or 4 years. I don't know if anybody would dare do that, companion for that.
You know, a lot of people will talk about that, and it's funny because your I don't know, your priority or focus changes when you're out on the water and you're facing the elements, and maybe some survival, although I never really was afraid for my life. But you know, you go on shore and your house is anchored offshore, and the winds start to blow, and you start to wonder, is my house going to blow up onto shore or whatever? So there's things that you are now paying attention to. You are not caring about people that are cutting you off in traffic. So all the little things that bother you on a daily basis, all of that stuff is kind of out the window, and it's a completely different focus. So my wife and I, we did really well together. It was, you know, it was a great time together. You know, and the only I'll leave you with this, but there was if you're spending that much time with somebody and the passages sometimes were like 20 days to get from Bora Bora up to Hawaii. And there was one time where, I don't know, maybe 2 weeks in, my wife said to me, oh, is everything okay? Are you mad about something? You haven't really talked to me in a while. And I just, all I could say is, well, you've been with me for 14 days nonstop. I just have nothing left to say to you. So, but that was just kind of a joke with us. But it was actually a great year and much more kind of relaxing than you probably can imagine.
That is awesome. Yeah, it kind of puts into perspective like what really matters, right? And maybe not worry about those little things like traffic, especially in Seattle.
Yes, and don't worry about the market, right? So
Yeah,
try to
exactly.
hedge
If
your
you're gonna, maybe
portfolio.
the storyline, if you're gonna go on a cruise, a sailboating where maybe you don't have internet for 11 months, maybe it's best you better get insurance on that investment portfolio, right?
Exactly right. And I think we went so long ago. This was back when you used to go to an internet cafe and hook up with a modem, and try to upload all your AOL messages to your family that you were still alive, So a little while back.
That's fantastic. My story isn't nearly as entertaining or fun, and it's just more recent. It's Final Four time, March Madness, and for all the listeners out there, about your bracket, my bracket's in total shambles, which is why maybe March Madness is so great. Everyone loves a great upset. We've had some great upsets, even if it means your bracket is toast like mine. I pretty much just tore mine up after the opening weekend and tossed it. But hey, you know what? I'm a big Wisconsin Badger fan. As you know, the Wisconsin Badgers made the Final Four. Not the Final Four that you guys are all thinking, but the Final Four, the NIT. It's not the big tournament, but hey, at least it's the Final Four. And so I'll take it. And lastly, we have the women's hockey team. Wisconsin women's hockey team won the national championship. So I have that to look at in terms of college sports. But Rob, that was a fantastic conversation. I learned a lot. Let's do it again. Get more maybe into the specifics and details about hedging, different strategies that financial advisors can look to use. I love to have you back on. Thank you again, Rob Swan of Swan Global. Real quickly, where can viewers get more information about Swan Global?
I think we have a wealth of information on our website. It's www.swanglobalinvestments. So that's like the birds, SWAN, globalinvestments.com. And a huge amount of material, our philosophy, white papers, discussions on correlations between asset classes, why math matters when you're constructing portfolios and why it's important to reduce volatility. And anybody, welcome to reach out to me or anybody else at Swan. We love to, this is what we do. So feel free to reach out if you have any questions.
And to follow up on that, I've been following Swan Global for some time, and I love your guys' content and research. You take a deeper look at the math behind a concept, but it's not so deep that somebody like me can't understand or read. It's just fantastic content and really interesting. So thank you all for listening to this episode of Adjusted for Risk podcast. You can watch the episode on our Adjusted for Risk YouTube channel, as well as listen to it on Spotify or iHeartRadio. Thank you again. Everyone have a great rest of your week, and thank you, Rob.
Take care, everybody.